Okay, let's uncover a really fascinating paradox happening right now in the e-commerce world. We're looking at Shopify today, and what we're seeing is a wild situation where the company's underlying business is absolutely booming, yet its stock has been experiencing some intense volatility. So if you want to understand what the market is missing, or honestly what it's absolutely terrified of, you are definitely in the right place.
We're going to take a complete analyst journey today. We'll quickly cover their business model and moat, dive into their Q1 2026 earnings, unpack the valuation and PEG ratio, map out their strategic growth plan, run a 2027 scenario analysis, and finally, give our final verdict.
All right, part one, business model and moat. Basically, how Shopify actually makes its money today.
Now, if you ask the average person, they'll probably tell you Shopify is just a website builder that charges a flat monthly fee. But looking at the actual data instantly corrects that huge misconception. Shopify isn't just a software subscription company anymore. A whopping 76% of their revenue actually comes from merchant solutions. We're talking transaction fees, payment processing through ShopPay, shipping, and merchant fintech like Shopify Capital. Only 24% comes from those monthly subscription plans. And why does this matter? Well, because their revenue model is literally perfectly aligned with their merchant success. When a merchant sells more, Shopify automatically earns more. They aren't just renting out digital storefronts, they've effectively built the toll booth on the e-commerce highway.
But here's the thing. A toll booth is really only valuable if people can't just drive around it, right? Their true competitive advantage is ecosystem lock-in. Like Jay Myers from Digidai points out, building basic e-commerce software isn't actually the hard part. The near impossible part is replicating Shopify's absolute army of partners. They have over 21,000 apps and thousands of developers building tools specifically for their platform. Once a merchant integrates their inventory, their marketing, and their accounting through this massive app ecosystem, switching to a competitor like Wix or BigCommerce becomes incredibly painful and expensive. That high switching cost, that is their ultimate moat.
Moving on to Section 2, Q1 2026 earnings. The classic story of huge business success colliding with a stock crash. Let's really unpack this paradox. In just the first quarter of 2026 alone, Shopify processed an absolutely staggering $100.7 billion in gross merchandise volume, or GMV, across its platform. That's a 35% jump from the exact same quarter the previous year. To put that into perspective, that means over $100 billion of global commerce flowed through systems powered by Shopify in just 90 days. It's massive.
And that immense volume drove their top-line revenue up 34% year over year to $3.17 billion. What's equally impressive here is that they maintain their free cash flow margins at a very healthy 15%, generating $476 million in pure free cash flow. This means they're not just growing rapidly, they're generating real, tangible cash while doing it. So with 34% revenue growth and massive cash generation, you'd think Wall Street would be throwing a party, right?
Well, here's exactly why the stock tanked 15 to 20% right after earnings. It really comes down to understanding the crucial difference between operating income and net income. You see, Shopify's core business actually generated a very strong $382 million in operating income, a huge step up from the prior year. However, Shopify owns stock in partner companies like Affirm, Globally, and Klaviyo. Because the broader tech market had a pretty rough quarter, the value of those specific investments dropped, and accounting rules forced Shopify to report those paper losses, which totaled a massive $1.08 billion directly on their income statement. This entirely dragged their official GAAP net income down to a $581 million loss. The market basically saw the big headline net loss and panicked, completely ignoring the fact that the actual day-to-day underlying business of selling software and processing payments was wildly profitable.
Okay, let's talk about pricing the stock. Let's transition from the raw earnings data to the actual price tag of the stock itself, because let's be real, even if a business is world-class, you can absolutely still overpay for it. Shopify's traditional price to earnings, or PE ratio, sits well over 100 times earnings, which frankly scares a lot of traditional value investors away. To understand if it's genuinely expensive, we need a plain English translation of the PEG ratio. The PEG ratio simply compares a company's PE multiple against its actual growth rate. Think about it this way. If you have a high PE ratio, but your earnings are growing incredibly fast, your PEG ratio will balance out and be low. Generally speaking, a PEG ratio under 1.0 is considered undervalued because you are paying a cheap price for the sheer amount of growth you're getting. And context is everything here. While Shopify's traditional PE ratio looks sky high on paper, their earnings are growing at an explosive rate, over 200% recently. When we factor that in, Shopify's PEG ratio sits at just 0.95. Now, compare that to some slower growing peers. Wix is sitting at 130, PayPal is way up at 185, and even private market estimates for Stripe hover around 1.20. So relative to its peers and its own breakneck growth speed, Shopify is arguably trading at a discount. The multiple is high for sure, but the growth engine completely justifies it.
Which brings us to Section 4, their strategic growth plan. Because as we all know, past growth doesn't guarantee future growth.
Make no mistake, Shopify is facing some serious challenges to keep this growth engine running over the next 3 years. They are heavily exposed to macro consumer slowdowns. If everyday people stop buying discretionary goods online, Shopify's GMV takes an immediate hit. We're also seeing rising credit losses in their Shopify Capital division, which just hit 3.7% of revenue, up from last year. And finally, they're spending an absolute fortune on the computing infrastructure required to run large language models for all their new AI initiatives. These are very real threats to their profit margins.
But to combat these risks and justify that premium valuation, management isn't playing defense. They are leaning heavily into innovation. President Harley Finkelstein explicitly stated on their last call that AI is now Shopify's native language, and they are effectively betting the future of the company on what they're calling agentic commerce. This bold vision really builds into their 3 strategic pillars for the next few years. First up, AI innovation, pushing their sidekick assistant to save merchants tons of time, and building agentic storefronts that actually allow buyers to shop using natural conversational language. Second, market expansion. Guys, they aren't just for small mom-and-pop shops anymore. Their B2B gross merchandise volume grew an incredible 80%, and international sales are absolutely surging. Third, deepening merchant solutions. They want every single merchant using Shop Pay, which now accounts for tens of billions in processing volume and boasts literally the highest checkout conversion rate on the internet.
Now I know AI is the favorite buzzword of every tech CEO right now, but for Shopify, this isn't just hype. Their AI investments are already yielding explosive, highly measurable results. In Q1 2026, AI-driven store traffic went up 8 times. Orders stemming from AI-powered searches multiplied by nearly 13 times in just a single year. And internally, 50% of Shopify's code is now written by AI. This allows them to deploy brand new products way faster without having to hire thousands of new engineers, which is exactly how they're managing to maintain those 15% free cash flow margins while still heavily innovating.
All right, Section 5, our 2027 scenario analysis. The bull versus the bear case. So, what does all of this data actually mean for the stock's future performance? Let's take everything we've learned and build a quick scenario analysis looking out toward 2027. In our bull case, the AI efficiencies we just talked about compound heavily. Market share grows, international expansion pays off big time, and operating margins expand toward 18%. In this rosy scenario, analysts project earnings per share could hit $3.71 by 2027, pushing price targets up near the $211 mark. But we have to be objective, so let's look at the bear case. If consumer spending suddenly grinds to a halt due to inflation or a tough recession, GMV growth gets sliced in half. If their AI infrastructure costs spiral out of control or software churn increases, the market is absolutely going to punish their premium valuation. In that scenario, EPS stagnates around $1.70, and the stock will likely face some severe multiple compression.
And finally, Section 6, the final verdict. Let's bring all these threads together.
Ultimately, what we are looking at here is the definitive commerce infrastructure of the entire internet. Shopify offers an incredibly wide moat thanks to its 21,000 app ecosystem, and it impressively continues to deliver best-in-class revenue growth of over 30%. Because of the stock's high beta, which just means it moves much more dramatically than the overall market, it's really best suited for long-term growth investors who can stomach the macro volatility and look past short-term accounting noise, like those paper investment losses we discussed. So here is the ultimate question you have to ask yourself after diving into this explainer today. Do you believe their compounding technological and AI advantages, along with their deeply entrenched merchant ecosystem, will actually outrun the heavy growth expectations currently priced into the stock? Before we wrap up, a quick reminder that this explainer is strictly for educational purposes, it is not financial advice, and you must always do your own thorough research before making any investment decisions. Thank you so much for joining me on this analyst journey today, and keep learning.